Hi there, it's Matt Samet with Fortress Financial, and I want to talk to you today about why a lot of investors fail. And that's the reality, that don't feel like you're alone out there. By far, the majority of investors fail. And there's a number of reasons, and I've written a lot about it, which I'm just going to pull out a few of the points that I have talked about that are sort of consistent points throughout. First off, you got to understand the difference between secular and cyclical cycles. I know it sounds a little confusing, but a secular cycle is the long-term cycle. We've been in one since 2000, and that's where we've seen crazy markets up and down. Cycles like that are basically were driven up to by debt. That's what happened from 1970 to 2000. I don't think debt's disappeared because it's actually increased it, and that's what lengthens the cycle. You need to cleanse that debt out of the system. So since 2000 to current 2016 here, we've been in this secular bear cycle. From 1982 to 2000 was a secular bull. Let me quickly talk about a bull. Invest. Stay invested. Low. Make sure your fees are very low. Don't get chased out. Don't overtrade. Just be smart. Be invested in good quality markets. Totally changes in a secular bear, and this is where most people fail in these cycles. They write it up and write it down. They love their advisor for a few years, then they hate them because you know what? They make lots of money, then they give it all back, and usually give it back plus plus. So it's really important to understand that this cycle you have to have triggers. You have to have buying points and exit points. And we actually give those to our customers. There's some fairly, I wouldn't call them easy, but we've created methodologies that are easy to use. We've done a lot of studying on them. So that's one. Second, in a type of market we're in today, you just can't buy and hold. It doesn't work. It does in that long-term bull cycle, which will start again, we believe, in 20 to 22. But right now, you can't buy and hold. You have to recognize that at some stage, you got to move out. Doesn't mean you got to be a trader, because a lot of people don't want to be buying and selling securities. If you're good at it, good for you. Do it, because these markets are great for that. But for investors, you just want to be very smart and have exit points. Next problem. So many people rely only on their advisor or bank. Now, that doesn't mean they're not smart people or good people, but I assure you, no one's going to care about your money as much as you do, number one. Number two, they will be managing hundreds, at times hundreds and hundreds of customers. Number three, they're not as proactive. They want to put you in something and keep it longer term. So what we tell our customers is you have to have some knowledge. You have to have some tools to track your securities. It's not tricky. It just becomes a habit, and that's what we want to teach people, how to do it right. So it's absolutely critical that you have mechanisms to count on you more than your advisors. The next point, and this is a big one, it's actually our first module that I talk about, and it's psychology of investing. Think about it. When things are the best, when things are absolutely the best, let's look back to 2006 and 7. Real estate was soaring. Everyone loved everything. Nothing could go wrong. In the States especially, they wanted to buy real estate left and right. The stock markets were humming. Everything looked really good. Canada was not much different. What happened in '07 felt like it was overnight, but things became a disaster. Things can shift quick. When were the majority of people investing? Latter part of the cycle. They buy as euphoria gets to a peak. When do they sell? When fear's at its peak. And that was in '08 and '09 when the market was at a bottom. Terrible. Absolute wrong timing. But it's because the way our minds work. Our minds work based on fear and greed. Greed drives us to buy. Fear has us sell. You somehow got to get away from that and totally flip-flop it, and we help customers understand that. Fees are monstrous. You can lose a huge part of your wealth by paying even a 2% fee versus a half of 1% like it should be. So we teach people how to save fees. Many people buy based on rumors or media or tips, especially at the tail end of a cycle. Worst way to invest, no due diligence there, and it creates a lot of problems. So usually when people get in a story, the story's over. It's too late. And then a lot of people underestimate the risk. The amount of portfolios I looked at that literally were incredibly aggressive, and the investors were told by their advisors that they're very conservative because you own a bunch of mutual funds or diversified portfolios. It was very aggressive because it was securities that could have been in high volatility sectors like small cap, foreign sectors. Doesn't mean you don't know those, but you got to understand the risk of your underlying portfolios. Otherwise, you're taking huge risk with your wealth. And the last one I had here was understanding risk management. If you're in securities, you better know when to get out. You better have methodologies on when to exit. Absolutely critical. And you got to have an idea on safe wealth strategies. Alternative type products, simple one is precious metals, how they help you in down cycles. We discuss all that, but these are just some little tidbits and some points here that you should think about to ensure that you're managing your wealth well and that at the end of the day it keeps growing for you. Thanks very much.